Thank you. I'm Dan Dreschel, the CEO of Ftrans. With me is Jim Lester, our VP of Marketing. There's $1 trillion of accounts receivable on the balance sheets of businesses with less than $25 million of revenue in the United States. We're here to talk to you about how we move that to bank balance sheets so that it's not equity funded by the small business but funded at bank rates. So the banks actually need this revenue. Most of you are probably aware over the last couple of years they've reevaluated the risk-reward ratio of their real estate lending. We have a study that shows that that 86% of them want to increase that. We can give that to you downstairs this afternoon. What we want to do is show you how we can contribute that. So with that, let me jump right into what Ftrans does. We work with small businesses to outsource their accounts receivable processes. In so doing, we make that receivable as an asset, a lendable asset for the bank. So Jim's showing you kind of a customer list here that we would work with a small business on. You can see it's graded down the left on a red, yellow, orange, and green scale. A customer would simply enter their receivables balances at the end of a month, and we would be able to produce off of that a borrowing base, which you can see here. That can be produced daily, weekly, monthly, so that the bank loan is only outstanding to the amount of the available collateral. Now, we work with these small businesses in various levels of depth so that we can outsource them at a very light level, such as we've shown here, or at a much deeper level where we do all the collections, the cash application, and lockbox to the funds as well. Having done all that for the small business, as a byproduct, we're producing for the bank the information they need to make this a safe loan. This is a view of a dashboard that a credit officer would see. You can see this is maybe the Central Region credit officer. He's got 33 accounts. He's got commitments of $8.8 million. He's got outstandings of 9.5, so he's actually over advanced on his commitments. He's got collateral of 11.2. And then you can see in the middle of the screen which of those accounts have certain classes of issues with them, whether their financial reporting isn't in on time, they're over advanced, they're losing money, and the condition of the credit qualified stack of accounts receivable that underpins all of this lending. So we can then jump into one of these categories. So let's look at the over advanced accounts. And you can see here's the over advanced accounts and the issues with those individual accounts. The credit officer could look at these, mark them for action. We'll click on one of those and hit submit. Now we've cheated and stuck the email in here so you can see what would happen. But this email would go to the relationship manager, perhaps to the relationship manager's boss and the regional credit guy that's involved with this account. And they would have a URL that would take them directly to information they would need to look at the loan to see if it's safe or what other actions might be needed. Let's move forward to one of the loans. So you can see here the loan on the right, it's a grade 4 risk. You can see the commitment amount. It's actually it's advanced beyond the commitment amount, how much eligible collateral there is. And we'd have the 3 key elements all contained in the system that we've gathered through the process of working with the customer on an outsourced basis and delivered electronically to the bank. So the financial statements, which would be gathered electronically monthly from the customer's accounting system, and the ratios would be automatically spread. We can go back and look at the AR and the collateral that would be involved with the loan and see specifically the credit classes of who the actual money's due from, the borrower's customer. And kind of any concentration, so if there's a large customer that's involved or any foreign AR, and actually look at the underpinnings of this loan. We can also see the condition of the loan on the borrowing base that we showed you earlier. By providing a bank with these simple and easy to use tools, they can separate the loans, the thousands of loans they would make to these small businesses, into those that they need to inspect, accelerate their ability to inspect them so that they can reduce their losses in this category, and expand their lending to businesses in the small business market. We're presently working with Synovus Bank in the Southeast, who was our partner bank in pioneering all this, and we're looking for banks around the country that want to expand their small business lending. There's no small pressure to do that today, and need the tools and systems to accelerate that lending in a safe manner and get those assets moved from equity financed by the small business on their own balance sheet onto the bank balance sheet. So with that, we'll look forward to seeing you downstairs. We can give you a copy of the Greenwich study so you can see what the banks are thinking. And we'd love to talk to any banks that are out there that want to accelerate their small business lending. Thank you.